Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, getting married is a time of bliss, hope and optimism. In many ways, it's a new beginning for the newlywed. But the last thing on the mind of most young couples is financial planning. Why? Well, because it's considered a delicate and tricky matter that most of us believe is best put off for another time. In reality, people get married to individuals with very different financial habits and experiences. To help you along with some crucial advice is Yashish Dhaya, CEO and co-founder of Policy Bazaar. Welcome to the show, Yashish. First things first, why is financial planning for newlyweds so important?
Well, it's pretty straightforward. You're getting into essentially a lifetime contract to kind of live together, manage your finances together. I think even for an individual before marriage, financial planning is very important, and I think financial and risk planning both are very critical. However, once one is married, they have the additional responsibility of another individual. See, if one can decide not to take a health insurance cover if they are single, but once one is married, the other individual will continue to spend for you even when you haven't taken a health insurance cover. So from that respect for the other individual, I think it makes a lot of sense to get into a bit of risk planning and financial planning, of course, because you have your joint dreams. You know, you may not want to buy a great house, but your spouse, your wife might want to buy a great house. Your wife may not want to go on an adventure trip to the Himalayas, but you might want to. And marriage is a bit about getting those goals together and planning for them together. And one of you may want to send your children to an expensive school, one of you may not. And again, it's about talking about those things and figuring out what do you want to do and planning for that, because if you're not planned, you're going to get very rude surprises.
Now, financial planning is of course divided into a number of categories. So let's start with life insurance policies, which are crucial for young couples. I mean, what would you recommend that they start off with? I mean, we have to keep in mind that we are addressing a very large range of, and usually young couples don't have that much of financial resources with them.
But a life cover does not cost that much.
Right.
So
and especially at a young age.
Especially at a young age, when somebody's getting married, I'm assuming they are between 25 to 35. Most of the people, good 90% of the people would be in that range. For them, taking a term cover of even a 1 crore rupees is going to be.
So what you're saying, go for term covers right at the beginning. Is that what you're saying?
It's very essential, because so far you had no dependents in most cases, and suddenly you're dependent on each other.
Right.
And specifically, there are two special cases here. If both have got income, then I think both should take out a term cover for themselves, because the family is dependent on that. They are both each other dependent on that. If one has an income, then it's even more essential that person takes out a term cover, because the other person is totally dependent on them for their financial needs. One cannot assume that they're going to suddenly start generating finances in case an unfortunate event happens.
Right.
In case you're a divorcee, and you've got one dependent from earlier, and you've got a second dependent coming along, and there may be kids both sides of the marriage, then you've got to have two term covers with two nominees. It's pretty straightforward, because both these groups eventually depend somewhat on your income. So I think a term cover is essential the moment you get married. It's pretty straightforward.
Right. But the way a lot of young couples look at it, and that may be a habit that one has, over the years inculcated, to say that, all right, I'll buy a life insurance policy, which you pay every year, a traditional life insurance policy, and then you get something back at the end of 5 years. I mean, would you recommend the traditional approach that has been used for years and years?
So it depends on the individual, right? It depends on the individual. If your objective is to get a regular sum of money every 3 years or every 5 years, which you can use for holidays, and do that in a slightly disciplined manner so that it doesn't strain you every time, suppose an individual has a 3 lakh rupee, 4 lakh rupee income, and they want to spend, let's say, 60,000 rupees every third year on a trip, right? That's part of their dream list. Then I think it would be good for them to take out one of those traditional plans, so that they can invest gradually, and they can take out that money at the right time. Which is basically a discipline issue. It's not a returns issue. You're not going to get very significant returns on that. You'll most probably get returns at around the 3%, 2 to 3% range. But it's a discipline issue, and those returns will be tax free. So that's an additional advantage. So 2 to 3% tax free is almost like a 6-7% with
so you talked about couples fulfilling their dreams, whether it's educating their child in an expensive school or a college later on, or
Yes.
going for these holidays. So how would you recommend that they go about financial planning in that sense, so that when they are at a certain age, they do have that corpus?
I think financial planning has got 3-4 objectives. I think the first one is, and it has to start that way, it has to start with risk planning, because your usual life you are sorted for. It's the unfortunate incidents that can happen if one of the individuals expires. More probable is one of the individuals get disabled or critically ill. At a young age, below 45, that happens a lot more often than death. Those covers need to be there. Basic health cover needs to be there. I think those are base risks one starts off with. Now the second risk one starts off with is what after 55, what after 65, when one is not working any further, but funds need to be there for that time. A great time to start pension planning is actually when you are very young, and specifically even before kids, because once the kids come, you will be earning and spending pretty much all the time, and hopefully your earning will be higher than your spending, but it can be the other way around also. So it's best to start saving upfront. So retirement planning should start almost instantaneously, and in your retirement planning you should have the right nominees and all. That's the second part. That's long-term financial planning. Then comes event planning, which is children graduating, and that will usually happen once kids happen. So one that can wait for when kids happen. Those are the kind of third level of planning. And then the fourth one should be entertainment planning, which is you have certain goals, whether it's a house, whether it's a foreign trip. These are all dreams, right? One can live in a 2-bedroom house, one can live in a 4-bedroom house, but you have certain dreams, certain aspirations, and that's what life is about. It's not just about earning money and keeping money. It's about achieving those goals. So it has to be very goal oriented. You have to have your goals up front, and then
so before we get into the specifics of health insurance, talk to us about some of the products that are available that young people can actually look at for good returns as they go along in financial planning.
Okay, so again, I break it up into risk and returns. When I talk about risk, if you look at a quadrant where one axis is essentially a probability of an event happening, and the second is the impact if that event happens. Now, if an event has got a low probability of happening, but it has a big impact if it happens, that's exactly what you need insurance for. Because if it's happening all the time and it's a low risk event, low impact event, you don't really insure for that. If it's very high probable and very impactful, nobody's going to insure you for it. So it's basically less likely, but when it happens, it has a big impact. Death, disability, critical illnesses.
Right.
It has to go in that order. Remember, not even 1% of India's population. Forget 1% of India's population.
I do want to add that one needs to be very non-emotional about this.
One has
aspect.
to be non-emotional about it, because
usually we pussyfoot and we say we don't really want to discuss these delicate issues. And
but these are the events that can jeopardize everything, and one has seen it so often. So these death, critical illness, disability, they need to be covered for. Then comes health insurance, which is a must these days with the cost of health insurance going up.
So should we talk about health insurance in more detail?
So in health insurance, what one has to do is basically take out a plan which is roughly, you kind of look at your incomes, you take something about 1x of your income, 1 times your income, limited to about 6 to 10 lakhs. You don't need to go above that for a health insurance plan. One has to look at, one can take out a joint plan, because you're a young couple, both of you are hopefully quite fit, and nobody has a pre-existing disease, etc. yet. Maybe once you turn about 50, 55, you can separate these into individual plans. But at this stage, you can take a joint plan. As kids happen, kids can be added into these plans, and they can start becoming family floater plans with the kids in them. So that's how one should go about it. One must, as I said, take out those 3 covers, the term, critical illness, and disability rider up front. Now, when you look at a health plan, you may want to look at plans which allow maternity covers to set in about 2 years into the marriage, because that's the earliest.
That's pretty much a given in most plans, the maternity plans.
They do mostly go up to 4 years. They do go up to mostly 4 years, but some plans do allow up to 2 years also. So go for a plan that has up to 2 years. Go for a plan that does not have too many sublimits, because the last thing you want when you get into hospital is to worry about what are you covered for and what you're not covered for. So try to go for a plan which does not have sublimits. If it has a 5 lakh rupee cover, it has a 5 lakh rupee cover. Up to 5 lakh rupees, stuff is covered. Try to get something for daycare, treatments, etc. Once these basic things are sorted, also plan for the retirement, also plan for the holidays, also plan for the house. There is no straying away from those.
Yashish, we're talking about newlyweds, we're talking about their financial planning, the importance therein of that. Tell me about the need for transparency between both the spouses in terms of financials, in terms of, what the other one knows about, how the habits are. I mean, is that important?
I think, it's not the only thing you would discuss, of course, but I think spending 10-15% of your time roughly on these matters is good. I think it's good to be saved the surprises later. I see so many couples when, the habits are so different. A bit of joint planning is not a bad thing. How much capital does each one have? How are they planning to bring it together? What are the incomes? What are the spends? What are the credit card pieces? It helps not getting into the bliss so much that 15 days later
bliss
you've woken up
blindly.
Yeah, you've woken up 15 days later with massive credit card bills in excess of income, and you've got strange pains going on for the next 6 to 8 months, which can lead to stress and sometimes even breakup, which is unnecessary. If a little bit of planning happened, those financial strains would be saved. I think joint accounts are a great idea because joint accounts allow you to pool your resources, which is also a very shock. Like if there were two individuals and they both had, shocks happen to everyone in terms of costs, etc. But if there are two individuals that pool their resources, they can balance out the shocks. So marriage can be a great place for whether two people are earning, whether one person is earning. From a financial planning perspective, if they move ahead together, they can, 1 and 1 they say is 11. So together they can be very, very, very strong place. But I think the transparency and having the courage to ask that, I've seen so many marriages where there's a surprise right after the marriage in terms of the financial situation of the other partner. I think a bit of talking about it is not a bad idea.
Right. And what about, home loans and, buying a new home and coverage of that? I mean, are those aspects really important for newlyweds?
So I think home insurance would come in once a person has a home. As would car insurance, etc. However, even if you do not have a home, you can insure the contents. Even as a rent-paying tenant, you can insure the contents. So if you have a television at home, if you have a refrigerator at home, if you've got jewelry at home, all of those things can be covered against theft at least. So yes, you should consider that as one of the risk mitigation pieces.
Right, Yashish, it's time to take viewers' questions. We've got Pearl Sodhi from Amritsar, and she says, I've taken a Bharti AXA Future Invest policy with a premium amount of 50,000 annually, and I have to pay for 5 years, but the policy term is for 10. I've chosen a debt fund, so I want to know if this is a good move or should I reconsider it? And she's got about 15 days to look at that policy.
I think it's a very good plan. Future Invest by Bharti AXA is a fantastic plan. In fact, its cost of operation is lower than some of the mutual funds. So I think it's a very good decision. Looking at a 10-year time frame, I would have advised Pearl to move more into equities rather than debts, because I think they will outshine equities, because if she just wanted debt, she could have gone in for a 10-year FD, and that might have given her pretty much the same returns. Of course, there's a tax element which would come into the Future Invest, which would make it more efficient. So from tax perspective, Future Invest will become more efficient. So overall, good choice. It's one of the lowest cost plans in the market. I would say one of the 2 or 3 lowest cost plans in the market. It beats mutual funds, but some of the mutual funds, in terms of total in-place cost of operation, the total in-place cost of operation of this plan is under 2%. However, the more important piece is I would advise her to move towards the equity side rather than the debt side. While debt is safer and she gets a guaranteed return, I think the equities will end up over a 10-year period giving her a return about 1.3 to 1.5 times what the debt funds will give.
All right, with that advice, we've got our next question. We've got Shobhanjeet from Dehradun. He says, I want to take a health insurance plan for my mother and father, aged 62 and 66. Please suggest me a plan with around a 2 lakh coverage.
So I think he should take an individual plan for both parents, one each. He can consider whether he takes a base plan. So if they are fit, he can go in for a base plan with the Apollo or Religare and Bharti AXA or with L&T insurance. So that's one possibility. However, if his parents have any pre-existing disease or any particular disability, then what he could do is go in for one of the senior citizen plans where there will be some amount of copay, but up to 5 lakh cover, and he is looking for a 2 lakh cover. It would get without medicals. So depending on the health of your parents, and maybe one parent is healthy and one parent is not healthy, you could go in for either a standard plan or a senior citizen plan, and both would work quite well.
Right, we've got Jyoti Sharma calling us from Haryana. Go ahead, Jyoti, with your question for Yashish.
I'm 28 years old and I have an annual income of about 4 lakhs. I wanted to look into an online term plan. What I wanted to know is that while purchasing one, what is more important? Is the sum assured more important or the policy term? I also wanted to understand what features that I should look at in my particular age group.
Sure. So when you're looking at a term plan, I think both are important. The amount of cover you take and for the longevity of the cover you take are both fairly important. Now people are getting this habit of buying covers all the way till they're 75 and all the way till they're 70. The ideal situation is to buy a cover till your working age. Term insurance is not meant to be an earning device, because otherwise everybody would take a cover up to 100 years and hopefully everybody would get paid at some point. Like, not hopefully, but yeah, most people would get paid at some point. But that's not the idea. That's what whole life plans, etc. do, right? Those are inheritance plans. So term insurance cover should be used as a term insurance cover. It should cover you till your retirement age, which is roughly about 65 to 70, and most insurance plans actually cover you for that. So I think that's the advice that I would pass forward to you. And you should look at the amount of cover that you are receiving. You should look at the add-ons that you receive. And I would say specifically look at critical illness and disability. Most people in the country are ignoring these. Remember, a disabled individual can have a financial implication much higher than death, or higher than death at least, as can a critically ill person. So please look at these two. There is of course a terminal illness benefit which one can also take, but remember, in a terminal illness benefit you will only get that benefit if a doctor certifies that there is no chance of improvement. So it's very rare that a doctor will actually give you that kind of certificate, and if they do provide you the certificate, they'll probably be about 2-3 months before death anyway, so you would receive those funds, but they'll be quite late.
Thanks, Yashish. Now that's all the time that we have on this show, but you can write to us at ask@policybazaar.com, Twitter, or on Twitter at @policybazaar_in, and we'll see you next time. Goodbye.